let's start off with something different, okay? First, let's take a deep breath and relax. We've taken a hit. I know it's your money. You probably had bullish positions. You might have had some bearish position. But on the last week, the volatility, last 10 days really, as it says on the front cover of the Hitchhiker's Guide to the Galaxy, and of course Starman's Tesla display, don't panic. All right, the Roadster now heading out into the universe, nice soft, don't panic. Okay, let's clear our heads, talk about where we are, things that one could have possibly done, and things that possibly can be done now, and then get to your questions. I have a couple already come in, it looks like, from Derek. We'll get to that in just a moment. We're going to spend 15 to 20 slides here just talking about some things where we are now. All right. So where are we right now? You're looking at essentially a 1-month chart of SPY. It's sort of got pixelated there when I copied it over. The other images, I promise you, look better than this. But this is SPY 1 month. And you see here at the peak at about 286 there. And of course, where we are today. And we did recover at the end. Now this was done at approximately 2:45, 3 o'clock this afternoon. So there's a little recovery at the end there, which is pretty good. When we see here what's happened in the last 10 to 12 days or so and what's been happening in the last month. So where are we right now? Are we in a correction? Well, I think so. That is personally. We've seen a move of 33-point drop on SPY, about 11.5% negative in 9 days. Dow's down roughly 3,200 or about 12% in those last 10 days, 9 days or so as well. Hold on, let me see, okay? All right, so that's kind of where we are now. Now, this link didn't copy over. I apologize for that. I normally don't use CNBC as a trading resource, but I came across this article today and I thought it was interesting. It was posted yesterday. Stock market is officially in a correction. And I just thought the notes that they had, some of the bullet points they had here were interesting. The average bull market correction is 13% over a 4-month period, and it usually takes 4 months to recover. That's a quote from Goldman Sachs strategist Peter Oppenheimer, January 29th. But, you know, he says the pain usually lasts for 22 months on average if the S&P falls at least 20% from its record high. All right, we just saw that we were down about 11 or 12% or so SPY from its recent high. Well, they're saying that if it crosses down to 229.80 for SPY into the bear market territory, the average decline is 30% if it's a bear market. So the discussion is now, are we in the smaller correction or are we heading into a bear market for the bigger correction? And what can we do, of course, in either situation? Okay, the last week of stock market drops, they feel has taken the S&P into correction territory for the first time in 2 years. So yes, a correction by definition. I'm not necessarily going to say it's a bear market, but again, that's what we can look at on these positions, okay? I'm scrolling through quick. I've got about 5 questions from Arvine and some others. I'm going to get to those in just a moment, okay? Now, this I thought was pretty interesting. This is a look back. This was their chart from the CNBC article, some past corrections, looking at decline amounts percentage-wise versus duration and the time it took to recovery, okay? So now it goes back, this actually went back into the 40s. I just grabbed from the 80s here. But from February to March of 80 was a 17% decline, okay? And it only lasted 1 month for a 17% decline, and the recovery to get back took 4 months. Now that 2-year time period, November 80 to August 82, 20 months of a bear market that dropped 27%, that 30% they talk about. But the recovery after the 20-month decline took 3 months to get back. Something changed economically, obviously. Okay, and you see here, there's that other one, the 32% decline, 87. It only lasted 2 months, but it took 19 months after that to get back to recovery. Now here's some of the ones we might look at right now as a consideration. Okay, October 97, 11% decline, happened in 1 month. We're down 11% in 9 days. It took about 1 month to recover. Makes about sense. 3 times the amount of time is what some investors use as a gauge. Going forward, of course, let's talk about what we know. The 57% SPX, SPY decline, broad market decline from 07 to 09. 17 months, took 49 months to get back. But you look at the recent 12 and 13% corrections from August 15, from February 2016. Remember that first couple of months in February 16, we just saw it go down. It started in November. I remember I was at my in-laws house for Thanksgiving dinner, and that's when that oil trick happened in November 2015. The oil went down, and then I came back to work going in December 1st. I'm like, I wonder if that's a signal of something else. Well, it took that 3-month time period to decline, but then it was 4 months to get back. So now, I'll be honest, I don't have the answer to this question. Are we in just this 12, 11, 13% corrections that we've seen before? Well, it seems like we are. It didn't take 3 months to get there. It only took the 1 month. Or in this case here, whatever happened back in 1980, okay? But here it took 1 month to recover. Here it took 4. This took 11, and the last one took 4 from 2016. So that's just, and it was, volatile in between, as we've seen with volatility now. You'd have days where it'd go up 200, and then the Dow would be down 300. Then it would go up 150, up 40, and then down 200. So there were big swings when that was going on, okay? And yeah, I'll get to that just at a moment. Okay, so this is just an interesting chart that gives some decent, I thought it was useful information and kind of interesting to eyeball. But what we don't know is that, are we done now at this 13, 11.5, 12% decline? Or are we heading more towards the 30, 35, or 40% decline range? Okay. Sam's thoughts is that he still feels selling is going to occur. Okay, that the market's still oversold. Now, what is the cause? I don't think there's any one cause personally. I think there's several causes that are occurring this. We did have some profit taking. I had a call with a coaching session with a gentleman yesterday, a PowerOptions subscriber, and I told him that I see this, some people call it the January effect, but a lot of people, when they do their taxes, what they end up doing is they also reorganize their money into different ventures into different places after 1 year. And we've had a very strong year, as Sam just mentioned. He still feels there's going to be more profit taking if there hasn't been already, or more fear, and people will be pulling money out, maybe going into different directions. That whole volatility hullabaloo had a big thing to do with what we've seen in the past few days as well. For some of us, it worked out extraordinarily well, and we're going to take a look at that in a moment. But a lot of bets were placed on volatility not moving because it really hasn't moved significantly in 2 years, 2.5 years, with a couple of glitches here and there. So a lot of bets on those volatility indexes and ETFs, people doing iron condors on the volatility indexes, butterflies maybe, short strangles, for example, and boom. Once that started to trigger, that started buying and closing and adjusting had to happen quickly, and that was pushing things up. You probably saw that Credit Suisse is getting out, actually, of the volatility. And the volatility, some of the ETFs, the 2 times and 3 times volatility ETFs were halted trading back a few days ago. Okay, CBOE has even talked about reducing some of their more risky 2 times and 3 times volatility indexes on their listings as well, for fear that it's something that investors shouldn't be trading. Well, it's something investors shouldn't be trying to make a profit off of, in my opinion. Sam, I know you do really well with UVXY and different things, but you're safe. But it shouldn't be looked at as something that's a strong way to make hundreds and hundreds of percents or things of that nature, even though you can. It's more designed to maybe help you hedge a portfolio. Bond yield and the interest rates. Okay, interest rates are going to go up. I've been saying that they're going to increase the interest rates. That's causing some money to be pulled out, money to be readjusted. The bond yield, of course, is increasing. That's one of the reasons. They're more attractive now, okay? Maybe it was in addition to all of that. It was just time for the market to take a breath. Correction was coming, okay? And we had mentioned that. And we've talked about that on several webinars here on Friday and more, but it was also coming. Is there also perhaps fear of budget overspending? New budget has been passed. New concerns have been coming out there. I'm not trying to get political and take one side or the other, but I'm saying there's a lot of money that seems to be flowing around, and a lot of people being indifferent on both sides of the aisle to the deficit as a whole. And maybe that's concerning with other things that are going on about how exactly does that want to go in. Anyone can chime in if they have any other ideas about this as well. But these are the general things we've been talking about, okay? These are the general ideas that have all led to this. One thing might be more important than another, but in general, it all has to do with it. That whole volatility switch, this just made it more pronounced, okay? That volatility spike of people having to cover positions when it started to go, that just made this more pronounced. But then again, the fall in the broad-based indicators, the broad-based markets, they were overextended, okay? It was time to do that. Now, what could have been done? Now, we have blogs for you. We have white papers on using stock or portfolio insurance. Insuring positions directly, I've got about 4 or 5 questions that have already come in about protective puts. We'll get to those in a moment, but also ways to insure your portfolio without protecting the stock directly. That's usually the best way. Might not be the best, most economical way, but that's usually the best protection you can get. So you can always go to blog.powerop.com. We've taught the ideas of limited risk trading at radioactivetrading.com. I've got questions coming in about that. And always, whether you're doing spreads, diagonal spreads, you're trying to use leverage, or just buying calls or buying puts, proper position sizing is extremely important. We're going to take a look at that in just a moment as well, okay? Anything you're trading should not represent too much of your portfolio. In leverage spreads, bear call credits, bull put credits, where you can easily take 100% loss. In a situation like this, I'm going to show you 3 trades I placed that I place every Monday for a 2-week bull put credit spread trade that's had a 94% success rate over the last 3 years, but only had a 30% success rate over this 2-week cycle that expired today. All right. But that's what can happen, and you can lose 100% on those spreads, so it shouldn't represent more than a certain single-digit amount of your portfolio for each spread position, okay? So what could have been done? Well, we have some references that we'll point you to, all right, in that view, and we'll look at that also, okay? All right. Now, were there signs? Yes. I mean, you had articles coming out, fear when the Bitcoin and everyone started talking about the fear of the Bitcoin and how it's going to hurt investors. That should have been a trigger to us all that something's going down. But the market sentiment tool is something that Ernie developed. He has 13 broad-based indicators that we use in the market sentiment tool. And we've set fences on those indicators. And Ernie tested this over a long period of time. What essentially it is looking at things such as stock highs to stock lows, new stock highs to new stock lows, percentage of stock gainers to losers, number of days SPX has been above its 20-day moving average or its 30-day moving average, for example, and things of that nature. We'll take a look at those later. And then we set fences on when it gets to this range, that usually is a bearish signal for that particular indicator, or it's a bullish signal. Now, it led up to bearish sells for extended period, and then on 129, the very bearish sell warning. Okay, when I see that on power options, my action is I'm going to adjust my married put positions. If I have gains, and you can see it here, the market, was still moving up. 28.39, 28.39, it's holding. It goes up to 28.72, then to 28.53, and that's when it was triggered. 10 bearish out of the 13, 3 neutral, and no bullish. Okay. Again, so married puts. If I'm in the married put, the protective put position, and it has a gain and it's at or near my put strike price, I'm considering rolling that put up to lock in some of those gains, or maybe adding an additional put. Some of you who follow the fusion trades, you know what you're going to see in a couple moments there. Also, it might be a good time to sell a call against a stock that you own, a bearish, a married put position or a collar. Sell the call at that point. If the market falls, you're going to keep most of that premium. You've already got the hedge in place. I'm in bull put credit spreads. When I saw the very bearish sell trigger, I thought about closing my short puts if they were profitable, or adding an extra put to create a ratio put spread to follow the new pattern that was going to be a warning. And in my long calls, I either bought puts against those or closed them out for a profit. Maybe rolled them up, but that's something we'll show next week as well. Okay, and wanted to consider adding insurance overall to your portfolio, whether you want to buy puts on SPY, QQQ, NDX, for example, DJX, things of that nature. Calls on the VIX, another way to insure your portfolio, UVXY, as Sam mentions. Okay, Plus, once you start seeing all the articles where people saying, oh, there's a concern of a market decline, then you have people coming out and say, no, no, you're going to miss the boat if you get out now. Everything's still good. Yes, we're extended, but this new high is only the new high till the next new high is hit. The minute I start seeing more conflicting ideas in general articles and general news sources, that's when I figure that no one knows what they're talking about. It's a 50-50 shot, so I might as well add protection and put some of my positions in a better place if the market falls, all right? Now, would any of it worked? And Sam, I wrote this before you sent your email, but if you've joined us before, you've heard Sam join us almost every Friday talk about his positions on UVXY as a market hedge, whether he's doing them as a spread position, it's a volatility ETF, but whether he's doing them as a spread position or a straight call or straight put, he's kind of following the trend of buying low and selling high, but using calls and puts and spread positions on UVXY. I've used VIX and VXX as a portfolio hedge, and most of it is less than 2% of my total portfolio value. Okay, and Fernando, I'm going to get to your question in just a moment. You just chimed in and we're going to see something. You think it's a good idea to sell a put on the VIX? Not right now, I don't, but we'll show you why in a moment. Okay, so following January 18th expiration, going into the next monthly cycle, January 22nd, Monday following January expiration on the 19th, excuse me. VIX was at 1120, closed at around 1103 that day. I bought 10 February 14th, next week's expiration before the standard expiration, 14 strike calls, roughly 24-25% out of the money that were for 75 cents. Okay, so, oh shoot, I'm sorry, I kind of messed that up. I'm sorry, no, I'm good. So the total outlay was $750, which is under 2% of my portfolio for the 10 contracts at the 14 strike, right? Now, why do I do this? Many of you know that 50 to 60% of my portfolio is in the radioactive trades. We're going to talk about those, got a lot of questions coming in on those. So it's limited risk already. But 10 to 15% of my portfolio is in the bull put credit spreads, following the weekly bull put screen on PowerOptions that we've created and I've tested and talked about. And I still do diagonal calendar spreads, about 10 to 15% of my portfolio. And then some remaining ones are straddles for earnings, okay? You know, buying call, buying a put based on an earnings play short term. Now, this one here I also don't need to worry about because with the market decline, even the earnings straddles that weren't profitable when the earnings came out, let's say on Tuesday, by Wednesday or Thursday, they were profitable because the market was falling. So the put side took over and these were still profitable in those. I don't have to worry about these because it's already hedged. So that $750 in VIX calls is designed to protect the speculative portion of my portfolio in leverage spread trades, or if I was just buying calls, buying puts for speculation, okay? Is it a good hedge? Well, this is an extreme example, but yes, absolutely it was. So what we have here is we bought those 10 calls on January 22nd. Normally, I would have sold here when those February 14 calls, is around January 2nd, were at 220. I'm sorry, February 2nd. I would have closed half here because they were at 220. Remember, I paid 75 cents, so have 100% gain. I usually would have closed half, but I kept them open. And then February 6th is when we had the jump. This must have been the 5th. I apologize. Okay, so we had that first jump on February 6th. Those 14 strike calls went to 1020, so I sold 5 of them. I sold half of my position at the first spike, so I've got 5 remaining. And then we went up the next day, and it sort of came down, so I sold another 2 here at 710 per contract and sold another 2 yesterday at 1140. I've got 1 call remaining that's roughly around 1450 of the 10 contracts I originally bought. And this is an extreme example. Why am I holding the 1? Well, just in case something catastrophic happens over the weekend. Might add to it. Really, I should with the profits I've taken on that. So we paid $750 out for the 10 calls. First batch closed was $5,100 in at 1020 for 5 calls. $1,400 for the next 2 calls, sold at 7. $2,280 for the next 2 calls, sold at 1140. All right, so that's $87.80 in, paying $750, so it's an $8,030 profit with the VIX hedge. Okay, I still have the one call remaining, as I mentioned. Now, but did it hedge? Well, as I mentioned, the radioactive trading portion of my portfolio, and John wrote in a moment ago and he says he's really glad he came across radioactive trading and bought the long-term puts on all his recent stock purchases before the last 10 days. Absolutely, I agree with that too. And so, but this case here, what we did, those of you that are in Fusion, and if you followed the Sony position 12, 15 days ago before the earnings, we converted it into sort of a long stock straddle. We own 2 puts and 100 shares of stock. So the earnings came out and the stock went up and this looked like a failure. But we're 8.2% down owning 100 shares of stock, and right now we're at a small profit, and if it keeps continuing to go down, we're going to be successful there as well. Okay, so I'm not worried about this. What I'm worried about is this. Okay, you've heard me talk about how I usually try to allocate no more than 10 to 15% of my portfolio to leverage spread positions. Following what I do and what I've talked about with the bull put credit spread weekly positions, on January 29th, I did open 3 bull put credit spreads. Netflix, 26,250 to 260 put for today's expiration was a 37-cent net credit. Did 6 contracts, was a $1,500 risk. I don't know where Netflix ended up closing. I do apologize, but right around 3 o'clock when I put the last touches together here, we see that Netflix was at 250.10. What does that mean? Full loss on the Netflix bull put credit spread. Red Hat, 121 to 119, 2-point spread, 25-cent net credit, 6 contracts, 1,200 risk. Red Hat is actually at around 124. Okay, 124, 125. So this one's profitable. But 6 contracts times 25. You know, so you can see we're getting $150 there. URI 33, 5 contracts. It's a 170 to 167.50 bull put, 1250 risk. URI is at 161.60. Okay, so let's take a look very quickly at the portfolio and PowerOptions and see where we are. It's going to be a subtly different view, I know, so let's go ahead there and get ready to adjust our eyes. Here's my 3 bull puts that went out today. As you can see, of course, the Netflix position, well, that took full loss. Okay, it's roughly 1278. You know, it was a 1,500, but with the credit received, 1278 full loss on the Netflix. 1085 on URI. Full profit here. And here's my diagonal calendar spread. Back on January 22nd, I only did 1 contract of a calendar spread on Amazon. Bought the April 1300, $88.50 per contract, so $8,850, and sold the 1340 call for February 9th at $7.50. Well, that expired. It's at $13.39. Okay. So this, by 1340, I'm sorry, did expire there. But what's interesting is that the stock had dropped before it recovered. I mean, the stock itself had dropped, but my call has moved up from 88.50 to 110.50. The reason for that is something else, something that helped us here. But this should actually be, I'll explain why in a moment, this should actually be at $66. So I should have another $2,000 loss on this calendar spread, in addition to the $1,000 loss on the URI trade and the $1,200 loss on Netflix. Okay. Now, why do I say that? Well, of course, what ended up happening is with these positions, the 1,278 Netflix represents about 3% of my portfolio. So number 1 is position sizing. Regardless if you're trading leveraged spread trades and you have insurance, it should only represent a small portion of your portfolio. The 1085 loss on URI is 2.7. And I mentioned the gain on the calendar spread, which was kind of dumb luck. You know, the stock dropped from 1327. It was down to 1315. We saw it came back up. But over the last 5 days, what happened even to that April call is the implied volatility moved from 0.26 to 0.44. If volatility, implied volatility remained the same, well, naturally we wouldn't be in the position we're in the market, but that 1,300 April call that I paid $88.50 for would only be worth $69, about another $1,700, $1,800 loss on that call, even keeping the $750 from the call that expired today. So you can see here that this portfolio, The speculative portion of my portfolio took care of itself, but I should have been down 1,900 here, the 1,085 I lost on URI, 1,200 on Netflix. So again, we would have been down about 3,500 or so. Why am I going through this all in detail? Well, I still follow the bull put credit spreads I talk about. It was only right 33% of the time this month. But think about it this way. Is the VIX considered a good hedge? I bought a 20, there we go. So I had bought a 20% out of the money put last month on the 22nd for today's expiration. I'm sorry, next week's, February 14th expiration. My apologies. It's a standard expiration, but they expire on Wednesday, so I go to the expiration, okay? If I had done that, and that was based on a hunch, that was based on the indicators that I saw, the sell warnings, even before the very bearish sell, I wanted to hedge my portfolio, so I used the VIX calls, okay? Now, if I had done that over the last 6 months, so starting on August 21st, when VIX was roughly around 13, 15, I might have bought the September 13th 16 call, and again, put about $700 into the trade to represent, 2% of the total portfolio for protection in case of worst case scenario. What would have happened each month? Lost $700 in September. They went to zero. No point here did it ever get to a place where I would have sold it for a gain. Okay, you'd think it was here, but it wasn't that much of a gain. It was maybe 5%, 10%. So it wasn't enough to consider a trigger to close, because you think, oh, well, if it keeps going up, then yeah, I can have more. And then from this spike to this spike, didn't even get me. So we would have lost the 700. Same thing from September to October. October after a standard expiration, buying for the Wednesday before the next expiration, and so forth. So 5 months of losing 3,500. If the implied volatility hadn't kicked in on my diagonal spread, that side of my portfolio would be down about 3,500 as well. And we made $8,000 on the VIX protection. So it does work as a hedge, but it's not like this $8,000 really jumped my portfolio. And think if you'd been doing this for a 12-month period, where the VIX has been in the last 12 months. Some of these months you would have gotten out with maybe a small profit or not a loss, 10%, 20% profit. But in general, allocating 2% per month to insurance, we would have run the risk of taking down close to 24% of our portfolio, which means to stay ahead, our total profits would have needed to be 45, 50% on the remaining portion of our portfolio. That's what's dangerous about the month-by-month insurance policy using SPY puts to insure a whole portfolio, VIX calls even, is that a lot of times you're going to lose the money you put aside. And if you never get the trigger in the downturn, you're never going to get back to square one. But this was a great hedge to do. This was a timing play based on the market sentiment tool, and it worked out in the end, okay? But what to do now? I'm going to get to your questions in a moment. And some of you had mentioned things here. Fernando had said, is it time to sell puts on the VIX? I don't think so, okay? I'm going to hold off for a moment, because if the market starts to go back up, the VIX is going to fall. The VIX puts are really expensive right now. And if I'm thinking the VIX is going to fall, I might want to buy puts, but they are really, really expensive. I can go 40% out of the money, 50% out of the money on the VIX and be paying almost $4 per contract. Remember when I was 20% out of the money? And for next month, right now, 20% out of the money, 40 calls are around 75 cents, sort of what I've been paying. But are we expecting the VIX to spike up more and go to 40, go to 50, go to 60? It's below, I think, 30 again right now after the jump in the market towards the end of the day. So I don't know if it's time to buy VIX calls right now unless you think there's going to be another trigger that's going to cause it to spike. I'm not sure if we're going to see the type of spike we just saw again. What about buying puts on the VIX? Ernie's thoughts were if we see the VIX go above 50, then yeah, it might be time to buy it, but they are extremely expensive. Better idea if we think the VIX is going to fall is maybe do a bear call credit spread or a bear put debit spread in that case, okay? Yeah, and Sam says in his UVXY positions, the options and volatility is usually paying up to $5 to $8 per trade, okay? Another reason, Fernando, why I'm not comfortable right now considering selling a put on the VIX, a cash secured naked put on the VIX, is that yesterday, market sentiment trigger went the other way. Valve sort of opened up and released. That bearish pressure on the indicators, you can see some of them there, the put-call volume ratio, SPX number of days up, SPX gap over the SMA 20, new stock 52-week highs. Well, this release caused all the pressure to move off the bearish levels and start to go into the bullish. We've had a light buy for the past 3 days, and then the bullish buy was triggered. Now, I'm not saying that this means that in 5 days from now, SPX is going to be back up to 2,800, 2,750 or anything like that. What I'm saying is that I'm hesitant now based on this indicator. I use this to adjust my trades, place trades, and more. But based on what I'm seeing right here, I'm holding off on Monday to do anything more extravagant. We have to anyway because the market's closed. But I'm holding off because the bullish buy has been triggered. I'm not sure if I want to buy calls on the VIX right now, because if it does start to move back up, the VIX is going to drop. Not sure if I want to buy puts on SPY right now, because if it starts to move back up, I'm going to lose money. An out-of-the-money bull call debit spread. I'm sorry, in-the-money bull call debit spread with a good probability. Or maybe an out-of-the-money bull put credit spread on one of the broad-based indexes might be a good idea now. But with the idea knowing we're going to manage it. But I wouldn't sell a naked put on the VIX even though it has high premium, because this is telling me that things have eased off. It might stagnate and move back up slowly for a little bit, in which case the VIX is going to settle quickly. Okay, it could settle very quickly. It could be back down to $15, $16 ranges in 5-10 days. It could also be up to 50. Okay, that's the nature of the volatility. So not a fan of selling into it like that on naked puts or credit spreads. But again, since the puts are so expensive, if I think the VIX is going to fall, I may consider a bear call credit spread or a bear put debit spread on the VIX also. Okay. As I mentioned, this means start buying. It means that the bearish indicators have eased. But now we have to ask, from what we saw in that previous discussion, are we in the 12% correction range, or are we going into 30% of a bearish market? The time will tell, but I think next week, based on the market sentiment, if it doesn't happen on Monday, maybe or Tuesday or Wednesday, you'll see some of these stocks start to move back up. You'll see some swings upward, as we saw at the end of the day today. But that doesn't mean 2 weeks from now we're still going to be up. Okay? How long would they go up? So what is the play moving forward? And we're going to get to the questions now because this relates to it. What to do now is to protect your positions in your portfolio. Protect the stocks with long-term puts, okay? Stocks that you're in, stocks you have a gain on, maybe stock you cut down and average down the cost, sold at half of it at some of the highs, but you're still holding it. Protect the rest of it with long-term puts. You're not throwing money away on insurance with the radioactive trading techniques. It's actually a second asset that works in your favor to manipulate. I know we're going to look at that with at least 3 or 4 questions I saw come in. You can also do that with calls. You're going to see a video blog next week on managing long calls. I know it's probably past the point, but it's always good material to have and something one of my customers asked me for. Okay, your portfolio as a whole, the speculative portion of your portfolio, consider, yes, buying puts on SPY longer term, or maybe VIX calls. But wait to see what the market does now. If we start to move up next week and things start to ease off, we see the VIX drop down to the 20, 18, 16 level, maybe that's time to buy some calls, but don't use more than 1.5 or 2% of your portfolio as a hedge. Same with the puts on SPY. Yes, you want to hedge your position, but you don't want to waste all the money putting 15 or 20% of your portfolio into portfolio insurance, okay? Because that will not only take away the gains if the market does recover, it also means that month by month, you might be taking too much of your portfolio out. Position sizing also applies to using broad-based indicators to insure a portfolio, all right? And of course, we talked about the bear spreads, and evaluate your position size. With this last decline that happened over the last 9 days, was there 1 or 2 positions in your portfolio that brought it down the most, whether they were long stocks, whether they were long calls, diagonal spreads that maybe you entered too many contracts, you felt really good about that stock, maybe you've been trading it for months on end. Evaluate your position size. The ones that hurt the most, maybe restructure them, do some of the repairs we're probably going to talk about in just a moment, or stock repair, option repair positions on them, but then maybe restructure the size. Cut it down so if there is another spike, there is another sudden shift, that one doesn't hurt you as much. We'll point these out later, but we always end up mentioning these. You know, the need to fix, if you need to fix broken stocks, go to the webinars page. It's a full webinar there on managing your broken stock positions. Or if you got assigned on a naked put where the stock fell too far, there are ways to manage that now. You don't have to just sell and take the loss, depending on your outlook. Okay. Also, we can use the stock repair tool. We've talked about that in a couple weeks. If you've got spread positions that are in trouble, on the webinars page, check out the one under the option strategies column for managing spread positions. And if you think we're in a bearish market, if you think we're going more toward that 30% bearish market range, that we are in a correction, but if you think we're going more to bearish, but you still want bullish income, you know, you still like to do covered calls, naked puts, and bull put credit spreads, consider the inverse ETFs, a covered call on SH, naked puts maybe on one of the 2 times SPY or QQQ ETFs, the inverse, which will go up in price if the market continues to fall. And if the market stagnates, these will stagnate too. Okay? So it's just another idea of not only a hedge, but continuing the type of strategies you're doing with securities that will be moving up neutral to bullish if the market becomes neutral to bearish. Okay? I'll have info on that for you next week as well. All right, so that was kind of the wrap-up I wanted to go through real quickly in the sense of where are we now, in my opinion? What are things that could have been done in your account? And what can you do going forward? What are some of the tools that you can use, such as the market sentiment tool, the ideas of protection, and more going forward in the market? Okay, so that's just what I want. Where are we now? What could we have done, and what we can do going forward? Most importantly, of course, remember, don't panic. We've got the tools. We've got the education to help you. Sam threw out 4 quotes here, 4 links here. SQQ, TAZ, FAZ is one of his favorites. Those are some of those inverse ones that he likes to use. And he mentions EVAN as well, even 10 and 8, I think he's going to say. All right, so all that being said, let's get back to the top.